Here we are at another tutorial organized by FCF, and we are considering ACC 111 Introduction to Accounting. So my name is Good News Guru Chief, and I'm a 300 level student of Accounting Department. So for today's class, we are looking at the principle of double entry. And so first, let's look at what the principle of double entry says. The principle of double entry states that for every debit entry, there must be a corresponding credit entry, and for every credit entry, there must be a corresponding debit entry, so vice versa, as we call it. So that's what the principle of double entry says. And it's important to know that the double entry principle does not state that the account which receives is debited and the account which gives is credited. That is not part of the double entry principle. If you add that as your definition of double entry principle before now, then you were wrong. So it's only a method used for explanation which could be faulted. That method of explaining double entry principle over time would fail. That's the truth. And so what we are looking at today is understanding the principle of double entry in a way that as you go on in financial accounting, you'll be able to understand all that will be done. Because the truth is, double entry principle is a fundamental aspect of financial accounting. It's not just a topic that is treated in year one, but something that you would apply in every aspect of financial accounting, even as you progress. So the double entry principle establishes that there are two parties to every transaction. One account or one party is debited and the other is credited. Not that the giver is credited and the receiver is debited. So now I want to understand properly the principle of double entry, and how then do we understand this principle? Because now that I'm saying that giving and receiving is not part of the double entry principle, and that your knowledge of double entry principle should not be sustained on this, then how then do you get to understand this principle in a way that you'll be able to apply this in every aspect of double entry, not just in this topic alone? Now, the double entry principle leaves us with a challenge of knowing what account is to be credited and what account is to be debited. That's the challenge we have in double entry principle, knowing that double entry principle tells us that one account is to be debited, the other is to be credited. But which account is to be debited and which account is to be credited? That's where the challenge is, and that's what we are looking to trash today. To understand this, you must know the balances of the different categories of accounts we have. Different categories of accounts we have. Now, I want you to take this practical example. If at night in your house there is currently no power supply and you are about to sleep and you want to be sure that the light in your room is off, how will you know? That's a question. Just think about it. There's currently no power supply in your house, and so that when the power supply is restored, you don't get to be disturbed from your sleep by the light. You want to be sure that the light is off. How do you get to know? Now, the way to do this is your knowledge of what position the switch is when it is on. So you already know that this is the position the switch stays when the light is on or when the switch is on. That's how you'll be able to know what position it should be when it is off. So this is the same thing that we are applying to the principle of double entry, which would be I'm looking at today. So we need to know what the default balance of every account is. Every account has a default balance. This is what the balance is meant to be on a norm. So knowing that would guide us into knowing what to do in every situation. So an account either has a debit or credit balance. There are two sides to an account, the debit side and credit side. So either has a debit or credit balance, just like a light switch has off or on positions. And so let's call the on position of your switch the default position. So you know that if you want to know if this light is currently on, even though there is currently no power supply, you are already identifying the position of the switch. Okay, this is its on position. Definitely the light is on. So if power is restored, the lights will come on. So that's something that you use in your daily activities. Now, there are two sides to an account or a ledger, the debit side and credit side. And that's what we said before, that an account either has two balances just because there are only two sides to a ledger. And now, this is the picture of a ledger. You have the debit side and the credit side. It is not receiving side and giving side. So, debit side and credit side. Now, I mentioned earlier that we need to identify the balances, the different categories of accounts we have fall under, so that we are able to understand adequately the balance that the account is meant to have. So we need to know the balances that the different categories of accounts have. That was what I said earlier. So based on this, there are different categories of accounts we have. We have assets, liabilities, capital, income, expenses. We mentioned that in accounting equation in our last tutorial. So these five elements can be divided into two categories of balances that accounts can have. We have assets, liabilities, income, and expenses. We can divide them into two different categories based on the two balances that are available for accounts to have. The first category is the category of assets and expenses. They are in the same category and their default balance is a debit balance. Every account has a default balance. So the default balance for assets and expenses is a debit balance. Then liabilities, capital, and income are also in the same category. Their default balance is a credit balance. So it's important for us to know this, that assets and expenses are to have debit balances, liabilities, capital, and income are to have what credit balances. So from this, we now build on to fully understand what double entry principle entails. So we can link this from the accounting equation. In the last video, the basic accounting equation we said was asset equals to capital plus liabilities. And if you remember, we treated an example. If you have not watched that video, you can check the link in the description. In the last tutorial, we treated an example where there was profit, and we tried to look at what effect does that have on the accounting equation. And I mentioned that profit is usually added to capital. So based on this, we can expand our accounting equation to be asset equals to capital plus profit plus liabilities. That means the assets of a business comprises of the capital of the business, the profit, and the liabilities. Now, profit made by any business is the difference between total income and total expense. Therefore, our assets will be equal to capital plus income minus expenses, because income minus expenses gives us our profit. So income minus expenses plus liabilities. If we expand that, we have assets equals to capital plus income minus expenses plus liabilities. So which we can express as assets plus expenses equals to capital plus income plus liabilities. The total of assets and expenses equal the total of capital, liabilities, and income. So this is the equation: assets plus expenses equals to capital plus income plus liabilities. Now this forms the basis for which assets and expenses fall into the same category, capital, income, and liabilities into the same category also. So it's because assets plus expenses equal to, because I mentioned last week that it's an equation with two sides. So two sides of the different balances. One side debit, one credit. But note that it will be mathematically incorrect to say that because based on this equation, assets and expenses are on the left side, that justifies their having debit balances. That's wrong, because assets plus expenses equals to capital plus income plus liabilities can also be expressed as this: capital plus income plus liabilities equals to assets plus expenses. And so looking at this now, capital plus income plus liabilities are now on the left side of the equation. So but then their balances are still credit balances, so we can't use that to say that okay, assets and expenses on the left side and that's debit. Definitely not correct. So now we've said that we need to identify the categories that the accounts involved in that transaction fall under. And the default balances that those categories have: assets and expenses have debit balances by default. Capital, income, and liabilities have credit balances by default. So we said that there are usually two parties to every transaction. Although in the treating of a transaction, you might have more than two accounts to that transaction. And the reason for that is because in that one transaction, there are multiple transactions. And we'll get to see that as we take examples. So there are multiple transactions brought into one, which can be fused into one transaction. So probably because there is a particular party that is sustained in both transactions. So that's why we would have more than two accounts involved in that transaction. So we are identifying the accounts involved in that transaction and the category they fall under, whether they are assets or expenses, capital or income or liabilities. So when a transaction takes place, you ask what are the parties involved. Now if you say it is this and that, so which category do these parties fall under? Are they under assets, expenses, capital, income or liabilities? So that will make us know what their default balance would be, and from there we are able to know what to do next. So the next important step is to know the implication of the transactions that took place on the accounts involved in that transaction. Every transaction has an effect. Based on what we did in accounting equation, there's an effect of every transaction in the accounting equation, which has the elements of asset equals to capital plus liabilities. So and that we discussed last week. So every transaction has an effect on those five categories or the accounts involved in that transaction. There is going to be an effect, either it causes an increase or a decrease in the value that those accounts carry. So we need to identify, does this transaction cause these accounts to increase or decrease? So where the transaction causes an increase in the value in that account, the transaction will be pasted on the side the transaction has a default balance. Now let's take a practical example. Let's assume that in a filling station there is an in and out entrance, and let's assume that there are people at those entrances taking inventory of those who are coming in and those who are coming out. So when somebody enters the filling station through the in gate, it means that there is but an addition to the number of vehicles in that filling station. So where there's an addition, it means that that particular vehicle went in through the in gate. So that's what it is. The default position is like the in gate of the account, the size through which value gets into the account that causes their value in the account to increase. So and the out gate means that vehicles are moving out of that particular filling station. So that's what we are considering. So where there's an increase in the value of the account, it means that we are going to post it on the default side, the size the account has its default balance. And when the transaction causes a decrease, it will be posted on the other side. That means this opposite side of the default balance. So just take note of that. When there's an increase, it's posted on the default side. So it means that where there's an increase in assets or expense, the transaction will be posted on the debit side of the asset or expense account. And where there is a decrease in the asset or expense, the transaction will be posted on the credit side of the asset or expense account. We said that the default balance of an asset or expense account is debit. So where there's an increase, you are posting it on the default side, which is the debit side. And where there's a decrease, it's going to be posted on the other side, which is the credit side. So by implication, we can say that for asset or expense accounts, the debit side is the increase or addition side, while the credit side is the decrease or subtraction side. Because we are saying that when value is added to that account, we are going to post it on the debit side. So it means that debit side is the side for increase and the credit side is the side for decrease. So we can see that in this letter for asset or expense accounts, where there's an increase or addition, to be posted on the debit side. Where there is a decrease or subtraction, to be posted on the credit side. On the other hand, where there is an increase in capital, income, or liabilities, the transaction will be posted on the credit side of capital, income, or liability account, because for capital, income, or liabilities, the credit side is the default side. So, and where there is a decrease, it's going to be posted on the debit side, because the credit side is the other side, not the default side, which we said where would be where decreases would be posted to. So we can say that for capital, income, or liability accounts, the credit side is the increase or addition side, and the debit side is the decrease or subtraction side. So let's take some examples. Mercy opened a provision store on the 1st of November 2020. She opened an account for the business with Trustworthy Bank PLC, where she deposited 150,000 as her startup capital. Now, we want to identify what account is to be debited and what account is to be credited. And like I said, first of all, we need to identify the account involved. So in this particular transaction, the account involved here is capital and bank, because she started business with an initial capital of 150,000, which was deposited in the bank account she just opened for the business. So the bank account is going to be debited because it's an asset. Now, when she starts a business, there's an increase in asset. The cash that she's introducing in the business causes the bank balance to experience an increase. When she deposits money into the bank account has an increase in its value. And because it's an asset account, which the debit side is the default side, we are going to debit bank and credit capital, because capital, we said, is meant to have a credit balance. So when there's an increase in capital, it's going to be credited to the capital account. So this is the ledger of the capital account. We are crediting capital with bank 150,000 and debiting bank capital 150,000. So the same day, she paid 25,000 for a store she rented, transferring through a mobile app. So here is a payment of rent via bank, because she paid through a mobile app. Now, the two accounts involved there are rent and bank. Rent is rent an asset or an expense, or a capital or income or liability. Rent is an expense. So, which means that it's meant to have a debit balance. There's an increase in rent that is being paid by 25,000. Prior to that time, zero has been paid for rent. So there's an increase in the amount of rent expense incurred by a business. So that makes us debit rent, which is an expense, with 25,000, and credit bank, which is an asset, because we are paying through the bank. That means the amount of money in the bank would be reducing at this point. So these are rent accounts, debited 25,000 and our bank credited with 25,000. So we are following through the initial ledgers that we opened for the first transactions. That's why you see capital is still in the bank account, because there was an initial capital which we debited to bank. So we are following through. What we are just doing is to bring the bank account from the previous slide to this and include the new entry into it. She withdrew 20,000 from the bank. We are debiting cash, we are crediting bank. Both of them are asset accounts. Prior to this time, she didn't have any cash in hand. So a withdrawal from the bank increases the cash in hand, which is the cash account. And that's why we are debiting it. A withdrawal from the bank reduces the bank balance of the business. So that's why we are crediting it. So this is our cash account, bank 20,000, and our bank account cash 20,000. We are sustaining what we had before. So next, she purchased goods worth 23,000 from Tolani. and paid 15,000 in cash to pay the balance later. She purchased goods worth 23,000 from Tolani and paid 15,000 in cash to pay the balance later. Now, earlier I said that there are two parties to every transaction, but in some situations we would have more than two accounts, and that is because there are two transactions or more than one transaction infused into one transaction, and majorly because a party is sustained in both transactions which are related. So in this case, there is a purchase of 23,000 from Tolani, both on cash and on credit. She paid 15,000 in cash and there is a balance to be paid, which denotes a credit purchase. So it means that there are actually three accounts involved in this transaction. We have the purchase account, we have cash, and we have Tolani, who is a trade payable. So purchase account is debited, Tolani's account is credited, and cash account is credited. Now the reason why Tolani's account is credited is because at this point we are owing Tolani. So Tolani is a liability, and we said that where there's an increase in liability, it will be posted on the credit side because the credit side is where the liability account has its default balance. For cash, there's a reduction in cash in hand because she made payments of 15,000 naira in cash out of the 23,000 naira worth of goods she purchased. But then why are we debiting purchases? So that's why we have this question. Among the categories of assets, liabilities, capital, income, and expenses, which does purchases fall under? So for a moment, think and answer the question. Alright, so purchases, we cannot categorically say it falls under assets, liabilities, capital, income, expenses, or any of that. Just like we expanded the accounting equation to arrive at assets, liabilities, capital, income, and expenses, we can actually expand that in accounting equation further, and which would bring about the introduction of purchases and sales and other things. But for now, it's important to know that the purchases account is the purchases and sales account usually dissolve into the inventory account, because when you make purchases, there's an increase in inventory. So it's good to understand it as that purchases made causes an increase in inventory. And inventory is an asset account. So where there's an increase in inventory, we are going to have to debit the inventory account. So since purchases denotes an increase in inventory, an increase in inventory is on the debit side of inventory account, which means we are going to debit purchases, because the implication of it is that purchases causes an increase in inventory, and inventory is to be debited where there is an increase in inventory. So what we do is to debit purchases. Let me take it again. When purchases are made, it leads to an increase in inventory, and we know that we debit inventory where there's an increase in inventory. So it means that we can say purchases is like the debit side of inventory account, because when purchases are made, inventory increases. So the implication of that is that we treat the purchases account where purchases are made as an increase in inventory, which is meant to be debited. So that's why we are debiting the purchases account. So our cash account is now credited with purchases 15,000. Remember I earlier said that there are two parties to every transaction, and that although you might have more than two accounts involved in that transaction, but it is more than one transaction fused into one. Now we see a practical example here. There's both a purchase on credit and a purchase in cash. So purchases account is having to deal with both Tolani and cash account. But now, since purchase account is a party in both transactions with Tolani and cash, we just infuse them into one transaction. Say purchases is having to do with Tolani and cash. So it's still two sides, but more than two accounts. This is our cash account. We are crediting it with purchases because she paid 15,000 in cash. So that represents cash purchase 15,000. This is Tolani's account with purchases also. There's a credit purchase from Tolani. Tolani is a liability, and that's why account is credited. Then purchases account, both cash and Tolani, the corresponding entry of both cash account and Tolani's account. Next, we are told that she purchased furniture of 7,500 naira on credit from Mr. Ali. People get to mix this up by including the purchase of another asset which is not an inventory by recording it in the purchase account. That's an error of principle. If you are doing correction of errors, that's an error of principle. You are recording it in the wrong class of account. Even though your trial balance would balance if you record the figures correctly, but then you've made an error. So when you purchase another asset which is not inventory, that means this is not what the business is dealing in. It's recorded in the asset's name, not purchases. So in this case, the accounts involved are furniture and Mr. Ali because it is purchased on credit. If it was purchased on cash or through the bank, it should have been bank account. So Mr. Ali is a liability. There's an increase in liability. So that makes us record it on the credit side of Mr. Ali's account. And furniture is an asset account experiencing an increase. Prior to this time, there was no furniture in the business. So there's an increase in furniture and an increase in liability too. So our furniture account is debited with 7,000 and Mr. Ali credited with 7,000. She sold goods in cash for 5,000 naira to Sandra. So there's a cash sale here. And when there's a cash sale, we are debiting cash because there's an increase in cash as a result of sale. Cash is received from this particular sale, which increases the cash account, the value in the cash account. Then there's an increase in amount of goods that have been sold, which is sales account. So there's a question also: which category does sales fall under? Is it an asset? Is it a liability? Is it capital? Is it income? Is it expense? So just like we did for purchases, when sales are made, there's a decline in inventory, even though the value is not the same as the value it was purchased, but nonetheless there's a decline in inventory when sales are made. Because if you remember the last tutorial, the individual sold goods higher than the value you purchased it, and we tag that difference as profit. So yes, sales probably made above, but we are not told there's profit, so we are just dealing in sales and the cash account. These are the two accounts involved in that transaction. So cash is traded for inventory, so that is the way it is. So sales account is like the a decrease in inventory, and when there's a decrease in inventory, it is credited to inventory account. So that's why we are crediting. So just as we did for purchases, when there was an increase in inventory as a result of a purchase of goods. So note that where transactions take place in cash, that is, payments are made immediately, the name of the person business was transacted with is not important. So we are not recording the transaction in that person's name. The name of the person is only needed when there is a credit transaction, a credit sale or purchase, and we'll need to have to reference to that particular person in the case of settlement, so that we're able to keep track of that individual business was transacted with. So our cash account experiences an increase, and that's why we are debiting it with sales of 5,000 and sales account credited with 5,000. So Messi withdrew goods of 600 naira at cost. So this is drawings in goods. It's not common for you to find drawings in goods, but it is important for you to know how to treat that. So drawings in goods could either be at cost or at a price above cost. It could either be at the cost, that means the value it was purchased for, or a price above cost, above the purchase value. So where the drawings is at cost, it will go through the purchases account, and where it is above cost, at a price above cost, it will go through the sales account. So in this case it is at cost, and so we are going to take it through the purchases account. So we are debiting drawings and crediting purchases. Now, which category does drawings fall under? Drawings is a reduction in capital. When the owner makes drawings, it's like the person is taking out of the investment he has made. So that's capital minus drawings. So if capital account is meant to have a credit balance, that means deductions from capital will be debited, and so that's why drawings account is debited. Then purchases is credited because we are taking it out of the purchases account. So we are not adding, there's no new purchase made, but there's a drawing from the goods that have been purchased. So that's why we are crediting purchases account. So we have our drawings account debited with 600, purchases account credited with drawings 600. She settled her debt with Tolani by cash, receiving a discount of 500 naira. She settled her debt with Tolani by cash, receiving a discount of 500 naira. In this case, Tolani's account is going to be debited. Tolani is a liability, and now we are settling that debt. It means that there is now a reduction in liability. So it means we are going to debit the account because it's a liability account, the decrease side of the liability account. The payment was made by cash, so we are crediting cash, and there was a discount received, which is an income in credit. Now, based on this, we can actually see that if you are using the giving and receiving principle, it can be faulted under this discount received. You are saying discount is received, and now we are creating discount received account, which is the correct double entry. So if we're basing our knowledge of double entries on receiving and giving, it means that we will debit discount received because we say there is discount received. So that's why it's important not to base your knowledge of double entry on that. Note that trade discounts are not recorded in the ledgers. Trade discount is given for bulk purchases, whereas cash discount is given for prompt payments. You would be told if a discount is given for bulk purchase, if it's a trade discount. If it's not told that it's a trade discount, then you treat it as a cash discount. So we are debiting Tolani's account with cash 7,500 because the balance in Tolani's account is 8,000. That was the value of the liability in Tolani's account, 8,000, and we're told that cash discount was received of 500 naira. So that means you are paying the balance of 7,500 naira. Then cash account is credited with Tolani 7,500, and discount received is credited Tolani 500. So the next stage is for us to balance accounts. So these examples we treated are like key points that you need to take note of, where mistakes are usually made, and that was why I selected those few examples, those ones involving discount, purchase of asset on credit, and all the likes. So after this, we need to balance accounts. And how then do we balance accounts? Like we did in accounting equation, there must be a balance in the accounts at the end of the period, because it's an equation, like I said, during the accounting equation, which has two sides. So the two sides have to be equal, and we expanded the equation to give us assets plus expenses equals to capital plus liability plus income. So our ledgers have two sides, so it means that there must be an equal total at the end of the period. For example, if you went to a market with an amount of money, on getting back home you will want to ascertain if the value of goods with you is the same with the amount of money you took out. So I went to the market, I purchased some things. When I come back, I want to see, okay, what are the things I purchased? What's the value of these things I purchased? Is it equal to how much cash I took out? If not, then is it more or less? So if the value of what you purchased is less than, of the goods you are with is less than the cash you took out, it means that you should have some change with you, and that change is your balance, and this time a positive balance. But if it is more, you probably purchase on credit, and difference is also a balance, but it's a negative one representing the amount you have to pay the person you purchased from. So we are also applying this to ledgers. So we want to balance the accounts using the previous examples. Those accounts that have been opened, we are going to balance them. And because of the volume of work, I would make available the slides, so you get them through the link in the description, so that you can be able to follow through this example adequately. So these are capital accounts, and we remember that there was an introduction of capital of 150,000, and that was all that we had to do in the capital account. So we balance the account, and the balance is 150,000. This closing balance represents the value remaining in the account as at present, just like when you go to the market and come back. So what is the balance I have between? That's the amount of cash remaining in with you after all the transactions you made during the day. Then we are balancing our bank account, and if you had followed through all the transactions we had, this was where we stopped at. It was an initial capital of 150,000. Rent was paid of 25,000. There was a withdrawal of cash 20,000. So that gives us the total is 150,000. That means the balance in the bank account is 105,000. That's 150,000 minus 25 plus 20,000, which is 45,000. So we have our balance as 105,000. And if you can see, it's consistent with what it says that capital account is meant to have a credit balance. So that's why we're having a credit balance here. Bank account, which is an asset, is meant to have a debit balance. So that's why we're having a debit balance. Then our rent, we paid rent through the bank of 25,000. So that's the balance in the account, 25,000. Then our cash account, the withdrawal from the bank, withdrawal of cash from the bank, 20,000. The cash sales made 5,000. The purchases that was made in cash, 15,000. The payment of balance to Tolani, 7,500. So, and we have our balance in the cash account as 2,500, representing the amount of cash the business has. Then our furniture account, there was a purchase of furniture on credit from Mr. Ali, and there was nothing else in the furniture account, no other transaction with furniture. So the balance in the account is 7,000. Mr. Ali's account, we have not paid him, so we purchased on credit from Mr. Ali furniture, 7,000, and that's a liability, and that's why it was credited, and the balance is credit balance of 7,000. In Tolani's account, there was a credit purchase of 8,000. Remember I said that where there is a transaction in cash, a purchase or sale in cash, we don't keep the name of that person, and that's why the cash purchase made from Tolani is not showing in our account at all. And the reason is this, because when the debt to Tolani is finally settled, we will see that there is no balance in the account. So meaning that our name will not show again. It will only be showing in our trial balance where we are still indebted to her or she is indebted to us. So as long as that is not present, there's no interpretation of any to another. We would not have the individual's name in our books. So there was a credit purchase of 8,000 which opened the account. Then we paid in cash 7,500 and received a discount of 500 naira. So the total is 8,000. There's no closing balance in Tolani's account. So we go to purchases account. There was a cash purchase of 15,000 and a credit purchase from Tolani of 8,000. Then drawings of goods at cost 600 naira, leaving our balance at 22,400. Our balance at 22,400. So then our drawings account, drawings of 600 naira, that leaves the balance in the drawings account at 600 naira. So for our sales account, there was a cash sale of 5,000 which we credited to sales account after debiting cash. And then we have our final balance as 5,000. Our discount received, there was discount received from Tolani in the settlement of the account of 500 naira. So now we move to trial balance. We know that after preparing the ledgers, the next stage is to go to our trial balance. And for this purpose, we'll still be using the previous example. So trial balance tests the arithmetic accuracy of the entries in the ledgers. So test the arithmetic accuracy of entries in ledgers, not necessarily whether or not double entry was performed correctly. So you can perform double entry correctly and still have trial balance totals being the same. So what we are doing is to transfer the balances in the ledgers to the corresponding side of the trial balance. So based on the example we treated, this would be our trial balance. Our capital will be reporting 150,000, bank 105,000, rent 25,000, cash 2,005, furniture 7,000, Mr. Ali 7,000, purchases 22,400, drawing 600, sales 5,000, and discount received 500. So the totals would be 162,500 are equal. So the totals are meant to be equal. I'm sure you already know that. In summary, to identify which account is to be debited or credited, you must know the accounts involved and the category they fall under, whether it's assets or expense or capital or liability or income. So you must know the category the accounts involved in that transaction fall under. Next, you must know the default balance of that account based on the category. So we know that assets and expense are meant to have a default debit balance. Capital, income, and liabilities, the default balance is a credit balance. So you also know that. Then you know the implication of that transaction on the account, whether the transaction that took place causes an increase in it being cash or which other account is involved in that. Then we are to post the increase on the default side and decrease on the other side of the account. So we've come to the end of the tutorial for today. Do well to subscribe to our YouTube channel and click on the notification bell. Like the video if you enjoyed it, and do well to share with all your classmates and friends. Then post in the comment section topics that you would want us to take tutorials on subsequently. I'd love to see them. So see you in our next class.